everybody. This is Harjinder, and here we're going to take a look at the additional practice questions for the first midterm exam that I posted on Blackboard. Hopefully, you've had a chance to work through the problems. In this video, I will work through question number 1, Durham Company. This is an old midterm exam question for 34 points. And the recommended time to complete the question is about an hour. In this particular problem, we're given the trial balance at the beginning of the year. And we're told that the company applies manufacturing overhead to jobs on the basis of direct labor hours. And for the current year, the company estimated that it would work 36,000 direct labor hours and incur $153,000 in manufacturing overhead costs. So we're going to use this information to calculate the manufacturing overhead application rate. So the manufacturing overhead rate for the year would be the estimated manufacturing overhead, 153,000, divided by the total budgeted direct labor hours, which works out to 153,000 divided by 36,000, or $4.25 for every direct labor hour. Now I recommend that you also try to calculate how much of the total manufacturing overhead was allocated to all costs during the year. And that allocation is going to be based on the number of actual direct labor hours worked. Now, if we look up this question, the rest of the details in the question, they've given us the corporate income tax rate, 12%. We'll need that later when we calculate the net income for the year. We're given information about raw materials purchases, the ending raw materials inventory, the split of raw materials between direct and indirect. They've given us total direct labor costs. And we're told that the direct labor rate per hour has been the same for the last 3 years. So that is something that we are going to have to use, because it doesn't look like we've been given the actual number of direct labor hours for the entire year. We know the total direct labor cost, and we also know that the direct labor rate has stayed constant over the last 3 years. Something that we can use to calculate the direct labor rate per hour is the fact that when the company made a budget for 36,000 direct labor hours in total, the budget for direct labor costs was 720,000. So we're gonna have to actually use that rate to calculate the direct labor wage rate. So $720,000 was the total cost of direct labor for 36,000 direct labor hours. So for each hour, that works out to $20 an hour. We're going to use this direct labor wage rate and the fact that the actual direct labor costs for the year was 700,000 to determine the actual direct labor hours for the entire year. So actual direct labor hours for the year worked out to 700,000 in total, divided by $20 an hour, and that gives us 700,000 divided by $20. We get 35,000 actual direct labor hours. Now, this was important for us because we needed to calculate the total manufacturing overhead applied to all jobs during the year. Now that would have been applied based on the actual direct labor hours times the MOH rate, the manufacturing overhead rate, which we just calculated. And that works out to then 35,000 hours multiplied by $4.25. So for the year, we will have applied to various jobs 35,000 multiplied by $4.25, $148,750. That's the amount of manufacturing overhead that has been charged to various jobs during the year. Then, as part of the requirements, we're asked to calculate the specific costs, direct materials, direct labor, and applied manufacturing overhead comprising the ending work in process inventory. So the ending work in process inventory had incurred $7,875 of direct raw materials and $10,000 of direct labor cost, which consisted of 500 direct labor hours. Now, this instead could have been a way to calculate the wage rate as well. We could have divided 10,000 by 500 to get $20 for the wage rate. So there were two places in which the hints were hidden to calculate the direct labor wage rate. Anyhow, so here what we have to do is calculate the cost of the ending. So cost of the ending work in process inventory. Now the ending work in process inventory will consist of three things: the direct materials, the direct labor costs, and the applied manufacturing overhead included specifically in the ending work in process inventory. So $7,875 given, $10,000 for the direct labor, that too is given. And then for the applied manufacturing overhead, it's 500 hours times $4.25. The 500 hours were provided. So 500 direct labor hours have been worked for the ending work in process. And our manufacturing overhead rate that we calculated was $4.25. 500 hours times $4.25, 2,125, gives us a total of $20,000 for the cost of the ending work in process inventory. So these were essential calculations to get done before we could launch into the next phase, which is the T accounts. Now for T accounts, we have to make T accounts for the three inventory accounts, which is raw materials inventory, work in process inventory, and finished goods inventory. And we've been asked to prepare T accounts for cost of goods sold, manufacturing overhead, operating expenses, and sales. So a total of 7 T accounts are asked. So set up the T accounts here. So we've got T accounts set up for raw materials, work in process, finished goods, manufacturing overhead, operating expenses, cost of goods sold, and sales. Now, the inventory accounts had beginning balances, so raw materials 7,000, work in process 18,000, finished goods 20,000, 7, 18, and 20. So beginning balance, $7,000 for raw materials. Beginning balance for work in process, 18,000. And beginning balance for finished goods is $20,000. We know for raw materials, purchases will cause raw materials to increase. Work in process, we add direct materials, direct labor, and the total applied manufacturing overhead. Those are the only three things that are added. Work in process. And so work in process will have an ending balance at the end of the year, which we have calculated to be $20,000. The applied manufacturing overhead to all jobs is $148,750. The cost of direct labor for the year we already saw is 700,000, so we can put 700,000 for the cost of direct labor. Raw materials were purchased on account 203,000. So add raw materials purchased $203,000. The ending raw materials inventory was costed at 10,000. So ending balance for raw materials 10,000, which means the total amount of raw materials used, must have been 7,000 plus 203,000. So 7,000 beginning balance plus 203,000. That's the amount of purchases minus the ending balance. And that's a total of $200,000. However, this 200,000 represents the total amount of raw materials used for production. And we're told that raw materials that were used in production were 80% direct, 20% indirect. So out of this 200,000 total raw materials used, 80% is direct material. So 80% of 200,000, 160,000 is direct materials, and the rest is indirect materials. So 20% of 200,000, 40,000 is indirect materials. Indirect labor cost is 27,000. Indirect labor will be added to manufacturing overhead. 27,000. Sales commissions, 36,000. Administrative salaries, 80,000. These are both to be included under operating expenses. So sales commissions and admin salaries. $36,000 and $80,000 respectively. Heat, power, and water costs were incurred in the factory, 42,000. So that's basically utilities for the factory, 42,000. Debit manufacturing overhead for that. Prepaid insurance expired during the year, $10,000. 90% relates to the factory operation, rest to the selling and administrative salaries. So the expired prepaid insurance basically relates to the insurance that was used during the year. 90% of 10,000, $9,000 will be added to manufacturing overhead, and the rest, 10% of 10,000, $1,000 is to be included in operating expenses. Manufacturing overhead was applied to production. We've already done that. Now just keep in mind that if we have debited work in process for the applied manufacturing overhead, we need to remember that the manufacturing overhead account itself should be credited for that amount. Direct labor rate has been same. We've already seen that. Goods that cost $1,006,750 to manufacture, according to their job cost sheets, were transferred to the finished goods warehouse. From where? From work in process. So that is basically the unadjusted cost of goods manufactured. So from work in process, the unadjusted cost of goods manufactured. So let's double check if that's what we will get. 18,000 plus 160,000 plus 700,000 plus 148,750 minus the ending balance is indeed 1,607,50,000. So this was interesting. We were given the unadjusted cost of goods manufactured. So we could actually, even if we had not calculated the cost of the ending inventory up here for some bizarre reason, if we got a different number, we could have double checked our math to see if indeed everything falls into place, and it does. Now, this unadjusted cost of goods manufactured is basically transferred to finished goods inventory. So goods are completed, taken out of work in process, added to finished goods inventory. Sales for the year totaled $2 million. So that's a simple T account. Just got to remember to put the sales on the credit side. Sales are revenue. You got to put them on the credit side of the T account. The unadjusted ending finished goods inventory was costed at 26,750. So ending finished goods inventory is 26,750. So ending balance 26,750, which means the unadjusted cost of goods sold for the year can now be calculated, beginning finished goods inventory plus the cost of goods manufactured minus the ending balance of finished goods, $1 million. That $1 million of the unadjusted cost of goods sold is transferred to the cost of goods sold account. So debit, cost of goods sold, credit, finished goods. Depreciation was recorded for the year, total of 31,125, 2/3 to the factory, 1/3 to admin. So 2/3 is part of manufacturing overhead, 1/3 is part of operating expenses, $31,125. So we're talking about depreciation here. 31,125. 2/3 of it, or 20,750, is to be added to manufacturing overhead, and 1/3 of 31,125, 10,375, is to be added to operating expenses. And that's it as far as the information, the transactions are concerned. So we should now be ready to go on to the next phase, add up the manufacturing overhead, the total actual manufacturing overhead is the sum of the debit side, so 138,750. The total applied manufacturing overhead is 148,750. So when we compare these two, we know that manufacturing overhead has essentially been over applied by the difference, which is 10,000. So we have a $10,000 over applied manufacturing overhead. Close the over applied manufacturing overhead. The adjustment is you want to debit manufacturing overhead by $10,000. So debit manufacturing overhead by 10,000, and you want to credit work in process, finished goods, and cost of goods sold. How much to credit to these accounts depends on the calculation. So you want to get the ending work in process, the ending finished goods, and cost of goods sold. You want to subtract the beginning work in process and the beginning finished goods inventory. So our ending work in process is 20,000. The ending finished goods inventory is 26,750. And from cost of goods sold, $1 million, you want to subtract the beginning work in process and subtract the beginning finished goods inventory. So that's $962,000 left over. The sum total of these amounts is $1,008,750. So how much should be allocated to work in process? You want to divide the ending work in process, 20,000, by the sum total of the three amounts that you just put together, 1,008,750. That fraction multiplied by the total amount of the over applied manufacturing overhead, $10,000, works out to $198. It's $198 and some change. So if you wish, what you can do is you can use the round feature. If you're concerned, you can use the round function in Excel to get rid of the cents. For the ending finished goods inventory, the balance is 26,750. Divide that by the 1,008,750 times the total amount to be closed for the manufacturing overhead, 10,000. It works out to 265,000. Again, it'll have a few cents at the end. If you want to do away with them, use the round function. And then what's left over is basically, because we were looking to allocate $10,000 in total, out of the 10,000, $198 is allocated to work in process, $265 are allocated to the ending finished goods, and what's left over must be allocated to cost of goods sold. So the result is we will credit work in process by $198. You want to credit finished goods by $265, and you want to credit cost of goods sold by $9,537. This journal entry must be posted back to the respected accounts. So for manufacturing overhead, we debited manufacturing overhead, so that adjustment is done. Notice there's no balance left over in manufacturing overhead after that adjustment. But for work in process, finished goods, and cost of goods sold, you're going to make these adjustments. You will credit work in process by $198, credit finished goods by $265, and you want to credit cost of goods sold by $9,537. The result of these adjustments will be to cause the ending balances to now change. So the adjusted ending balance or work in process will now be 20,000 minus $198 or 19,802. The adjusted ending balance for finished goods will be 26,750 minus $265, 26,485. And the adjusted cost of goods sold for the income statement will now be a million minus the 9,537, 990,463. Okay, so it is important to remember to post the journal entry closing the over applied manufacturing overhead. And now you are good to go to the next step, which is to prepare the financial statement, the income statement rather, and the schedule of costs of goods manufactured. The name of the company is Durham Company. You're making a schedule of cost of goods manufactured for the year ended. So the current year began on the 15th. So the year will end on January 31st, 2017. Okay, so we know what a schedule of cost of goods manufactured looks like. You want to start with direct materials. For direct materials, you will begin with the beginning raw materials inventory, add raw materials purchased, which gives us raw materials available for use. Let's just go and link back. Our beginning raw materials inventory was 7,000. Raw materials that we purchased were $203,000 in total. So the total amount of raw materials that were available to be used is 210,000. From the 210,000, subtract the ending raw materials inventory. The ending raw materials inventory was $10,000. So that works out to 210,000 minus 10,000 raw materials used for production in total, 200,000. Of this amount, indirect materials were 20% at $40,000. From 200,000, take away the $40,000 for indirect materials, and we get the cost of direct materials, $160,000. Next up, you'll have direct labor costs, which were provided to us in this problem, 700,000. Next up is manufacturing overhead. For these, we'll go back to the T account. These are the items: indirect materials, indirect labor, put an O for the labor if you'd like. Now, the dollar amounts were 40,000 for the cost of indirect materials, 27,000 for the indirect labor, so on and so forth. Just copy them down from the T account. Add total to get 138,750, and that's the total actual manufacturing overhead. Keep in mind that when we add together the cost of direct materials, direct labor, and total manufacturing overhead, the sum that we get is equal to total manufacturing costs. To this total manufacturing cost number, we will add the beginning work in process and deduct the ending work in process. The beginning work in process was $18,000. The ending work in process is, after the adjustment, the ending work in process is 19,802. So it's important, keep in mind, use the adjusted balance for the ending work in process. Subtract the ending work in process, you get cost of goods manufactured. The adjusted amount, 996,948. And if you were to compare this amount to what we had up in the T account, the unadjusted cost of goods manufactured was 1,006,750. After all the adjustments for the over applied manufacturing overhead, the actual cost of goods manufactured is 996,948. You're also asked to prepare an income statement. So I'm just going to go ahead and prepare it here. Income statement. And for the income statement, we'll begin with sales. So sales were $2 million. Cost of goods sold. For cost of goods sold, we want to show the, or rather prove the fact that the cost of goods sold should be 990,463. We want to be able to prove it. How do we get to that? Well, we'll say we began with the finished goods inventory, add cost of goods manufactured. So beginning finished goods inventory was worth 20,000. The cost of goods manufactured for the year is 996,948. Added together, we get 1,016,948. That's the cost of goods available for sale. From the cost of goods available for sale, you will subtract the ending finished goods inventory. The ending finished goods inventory from the T accounts after the adjustment is 26,485. So subtract $26,485 from the cost of goods available. You get 990,463, and that's a good check number. The adjusted cost of goods sold, according to our T accounts, is 990,463. Indeed, that's the case. That's our cost of goods sold. Subtract the cost of goods sold from the sales. You get gross margin, 1,009,537. From the gross margin, we will subtract operating expenses. Now, we forgot to add up the operating expenses T account. Always a good idea to show the total amount. So that's the total. And that total is made up of these four items: sales commissions, $36,000, admin salaries, 80,000, insurance and depreciation respectively. Total operating expenses, amount to 127,375. Subtract the total operating expenses from gross margin, and we get operating income 882,162. In the problem, we were told the income tax rate is 12%. So that's the income tax rate. So 12% of the operating income will be the income tax expense. Calculate 12% of 882,162, get 105,859, subtract it from the operating income, and you get net income for the year 776,303. And that was basically what was required in this first problem. I will post this Excel file on Blackboard as well. Now, I'd encourage you to, if you've not already done it, to practice this question on your own.